The Retirement Café Podcast, episode 44, When Buying an Annuity is the Right Choice, with William Burrows.
Retired or thinking about retirement? You've come to the right place. Welcome to the Retirement Café Podcast. In each episode, we bring you an important conversation with insight, tips and knowledge, all designed to help you live a fulfilling and successful life in retirement. Here's your host, Chartered Financial Planner and Accredited Later Life Advisor, Justin King.
Hello and welcome to the latest episode of the Retirement Café Podcast, which is brought to you by MFP Wealth Management. This week, we are discussing one of the key questions many people have as they approach their retirement and have to decide what to do with their hard-earned savings, well, hard-earned pension savings specifically. And that's the question of whether to buy an annuity or enter into something we call in this financial services world, or enter into drawdown. So I'm delighted today to be joined by William Burrows, who's very well known within the financial advisor community as something of an expert in annuities. He's a qualified financial advisor. William is regularly quoted in the press on all matters to do with retirement options. So very warm welcome, William.
Well, it's good to be here, and I'm looking forward to this.
So William, can you tell me, or tell our listeners a little bit about, how you got involved in the sexy world of pensions and annuities?
Well, the story started about 25 years ago when a group of us got together and set up the original Annuity Direct. And you've got to remember, 25 years ago, nobody knew very much about annuities. It was compulsory to buy one when you retired, and interest rates were about 15%. So you really got a good deal for your money. Now, over time, the rules have changed, and back in whatever it was, 1994, pension drawdown came in. And I think, I just make the point that for the last 20 years, we've seen ourselves as the balanced, advisor. On the one hand, we've been saying you can invest in an annuity. On the other hand, you can invest in drawdown.
Yeah. So could you give a little bit of a, to explain to people who may not even know what an annuity was? I remember the first time I came across it, I think it was on the Monopoly board. If I got a chance or a community chest, I can't remember that, I got an annuity. And I remember thinking, well, I don't know what that is, but I realize I'm getting some money. So that's a pretty good deal. So what is an annuity?
Basically, an annuity is a policy where you convert a lump sum, a pension pot, into a stream of income. Annuities have been around since the Roman times, so they're one of the oldest products. But I think the easiest way to understand an annuity, think of a mortgage in reverse. Everybody will know what a mortgage is. You borrow money from a bank or a building society, and then you make monthly payments, and each payment is interest and capital. Now, with an annuity, it's the complete reverse. You're giving money to an insurance company, and in return, they're paying you back your original capital plus interest rate. But the important thing is the payments will continue for as long as you live. So you could think of it as a bet against the actuary. If you're 65, they might say, well, we'll give you another 25 years. So if you live to your to be 100, you've more than won the bet. If you die in your 80s, then they've won the bet. So there is this pooling, and technically it's called mortality cross subsidy. So those that die earlier subsidize those that live longer.
Well, surely the insurance company always wins.
Well, put it this way, the odds are fairer than you think. And the point I would make is that, a lot of people, will probably live longer than they expect.
Yeah. And it was a cheap jibe on the insurance company always wins, because I always think about, I hope never to claim on my insurance policy, but on my house insurance policy. But I'm very glad that I have the ability to pay the premiums every year. And it's one of those ones I hope pay the premiums, and I hope that I never claim. So I hope that it's always a waste of money. And that's the benefit of insurance, isn't it? And of course, the insurance annuity provides is against living a long time.
Well, that's right. I mean, as the Americans say, it's insurance against, outliving your assets.
Absolutely. So why in particular have they fallen out of favour?
Well, I mean, there are two things. I mean, there's a famous quote from Lord Grantley in the House of Commons all those years ago. There are two reasons why you shouldn't buy an annuity. One, they're against the interests of the family. When you die, there's nothing left. And secondly, they're a lousy investment. So if you unpack that, annuities are they're priced on return from gilts and bonds. Now, returns on bonds and gilts have fallen like a stone. So if you take my mortgage in reverse example, people are getting their own capital back, but the interest rate on top is very low.
Yeah.
And I would sort of guess that, the implied interest rate, is probably less than, 2%. The other factor that makes annuities less attractive is that the annuity dies with the policyholder. If people are married, they would normally have a joint life annuity, so it carries on until the spouse or partner dies. But at the end of the term, there's no lump sum investment. Now, a lot of people want to leave an inheritance, and I'm sure we'll talk about this later, but the main thing about pension freedoms is it's given people the choice, the option to leave money to the children.
Yeah. But I think, of course, to me, this guarantee that it gives people that once you've purchased your annuity, you will get that payment forever and a day without having to worry about what interest rates do, what stock markets do, etc. Of course, so that's a real benefit. But what about inflation?
Yeah, inflation is like sin. Every government denounces it, but they all practice it. I think your listeners will appreciate if I just give a simple example. So, take £100,000. 5%, £5,000 is the key figure. That's what you used to be able to get for a single life level annuity. So you give an insurance company 100,000, and in return you get £5,000 a year back. But that's a level payment; it doesn't increase. If you want to have inflation proofing, you start off at 3,500, and then that will increase with inflation. So you can see from that example, it's going to take a long time for the increasing annuity to catch up with the level annuity.
So have you got an idea, and I'm sure you do, but have got an idea of what point do you break even? So if you were a 65-year-old male buying an annuity today, either the level one or the index linking one, how long do you usually have to wait before? I mean, I suppose it all comes down to the inflation figure, of course. But what would your estimation be of what point? How long do you have to live?
Well, the crossover point is sort of about 15 or 16 years.
Right. So, of course, obviously, your health makes a big difference. Talking about your health there, I mean, you've probably got an idea of, obviously, every person who's buying an annuity has got an idea of what their life expectancy is. I do think that people possibly underestimate how long they're going to be staying around for. But how much does your health and your kind of your social factors that you come into an annuity pricing?
It makes a lot of difference. Annuities are priced on both the interest rate and also how long the insurance company think you're going to live. So if you've got a heart complaint or you smoke, the chances are you won't live to your normal life expectancy. So the insurance company will give you a boost. I tell a funny joke. I was on we call these things enhanced annuities, and I was on the phone to somebody from America, and I could see that he was a bit confused about these annuities. So I said, well, if someone's got a dodgy ticker, they will get a higher income than somebody who's fit and well. At that point, he burst into laughter. It wasn't till later I realised that what he referred to as a ticker was quite different to what we were referring to. So enhanced annuities, just pay out a higher income for those people who, are in poor health. But I make a really important point. There's no free lunch in this. So, so if I give some figures, so probably you can get 10% more income. If you smoke, you might be able to get 20 or 30% more income if you've got a cancer or a heart disease. But there's no free lunch. All the insurance companies are doing are accelerating the payments back to you. So actuarially, they're what I call neutral.
Yeah. So now a lot of people may have deferred, or I think they have, and you're right, we'll cover this later on, but a lot of people will have possibly deferred the idea of buying annuity, or even just said, no, I'm not going to do that. We've got pensions freedom and they don't have to buy an annuity any longer. Is there a point, do you think, in their retirement journey that they should reconsider that?
Now, you don't realise what a good question that is. I think the right question is there an optimum time to buy annuities? Now, I don't want to get too technical on this, but annuities are priced on this concept of mortality cross subsidy. So if you're 60, the benefit from the mortality cross subsidy is relatively small. Once you get into your 70s, it starts becoming meaningful. And then certainly, by the time you get to 75, 80, it's really quite a lot. So I think the optimum time to buy an annuity used to be, in the old days, whenever that was, 60, 65. Now, it's 70, 75. And then if you combine that with what I call de-risking your pension pot, then I think it makes sense if you're in drawdown and you start getting into your 70s, you want to take less investment risk. There's more benefit from the mortality cross subsidy. Peace of mind and security becomes more important to you. That's the time you should think about, converting monies into annuities. Yeah.
And of course, your circumstances or personal circumstances may have changed significantly in that retirement journey already, hasn't they? Because if you're doing it at 75, 80 and you've been already retired for 20 years, you may no longer have a spouse. Your health may have declined, so therefore you may get a higher annuity from that basis. Your living expenses may have actually fallen. I mean, I find that a lot of our clients in their 80, 85, they're actually spending a little less than they were spending in their 60s. Maybe they're just not wanting to do so much for foreign travel, or haven't got quite as expensive hobbies and pastimes than they did have, in their early part of their retirement.
As a financial planner, I'm sure you'll agree, it's not about the product, it's about, people's objectives. And I think the hardest part of what I do is not explaining the annuity options, because that's relatively straightforward. The really difficult thing is getting people to be clear about what their objectives are. So I say to people, I don't want to put, words into your mouth, but if you turn around and tell me that what you want is a sustainable income in real terms, keeping pace with inflation, without taking undue risk, leaving income to your partner if you die first. Now, if you unpack that, that is, probably an annuity. But of course, a lot of people start off by saying that they want freedom, a bit like Brexit. Give me control. I want control and I want freedom. But of course, as my headmaster at school used to say, freedom isn't licensed. So just because you've got pension freedoms, it doesn't mean that you should spend your money unwisely. So we're back to an annuity because it's the only policy that will pay a pension, a guaranteed income for life.
Yeah, fantastic. So, William, I'd just like to maybe draw this episode to a close with just some final comments, though. So, final question for you is, if people want to know more about annuities or maybe to try and get an indicative rate of what an annuity might provide for them, where would you recommend they start looking for that?
There's a number of good websites. I know a very good one, williamburrows.co.uk, lots of good information. I've got a few calculators. I forget what they call themselves now, but the Money Advice Service website has a very good calculator. And there are lots of other websites. Just put annuity into Google.
Absolutely. So, of course, as we'd always say, just finding the product and the information is only half of the story, and actually getting some advice about how to tailor that annuity to your requirements is probably the key thing. But we both would say that, of course, because we are advisors.
Well, I think before we finish this, spot on annuities, if I cut to the chase, annuities got into a very bad space simply because there were people like me and some other good advisors who were recommending annuities to suit people's circumstances. But a lot of non-advised brokers and some of the insurance companies piled into the market, and they were selling annuities on rate. And you probably won't believe this, but I had really clever, sophisticated people come to me 10 years ago, and they said, Billy, I like what you say, but just give me the best rate you can. And I think I make the point, it's important to shop around, because you can shop around insurance companies and get the best rate. But it's even more important, in fact, it's much more important that you ask yourself, is the annuity the right thing for you? Have you got the right options? Are you, buying it at the right time? And the final thing is, people don't realize they haven't got to put all their eggs in one basket. So you don't have to put all of your money into an annuity. There's no reason why you can't, what I call, fade your annuities, buy it over time.
Absolutely, a blended approach. That's fantastic. And well, thank you, really. Thank you so much for your time this morning. We're going to carry on a little bit later, and I'm going to cover off some of the pension freedom things that on the next episode. So stay tuned and listen in for that in a following week. But if you would like to find out about more about William's guides, you check out the show notes on the website at retirementcafe.co.uk, where you will find all the useful links to services where you can find out more information about William and the services he offers. And obviously the government site, we think it's Money Advice Service, but it's probably changed its name, where you can get some comparison quotes. So if you've enjoyed this episode, please do a review on iTunes. They're always very welcome. It helps us get this information out to more people like you. So thank you again to MFP Wealth Management, who sponsor this episode and podcast. And until next time, this is Justin King at the retirementcafe.co.uk.
Thank you for listening to the Retirement Café Podcast with Justin King. To find out more, you can find us online at theretirementcafe.co.uk.